Guys, Killstokes here. Welcome back to another episode of the Trading Coach Podcast. This is one of our video episodes, and we will be diving into the charts for a little bit. So if you are a visual learner, make sure you check out this on YouTube or Spotify. If not, no worries. You can always enjoy it and get plenty of value listening to it wherever you are. Now, in my most recent episode of the Weekend Trading Edge video, the one that I do on YouTube each and every weekend, I expect that you're subscribed so you know what I'm talking about. If not, make it a part of your weekly routine. I shared a potential 500 plus pip opportunity on the pound yen. Now, as always, the idea was built from the technicals first, as I am a technical first trader. But I also mentioned that, especially in big moves like this, sometimes the market needs a spark, something to help ignite it and push it up to those zones. And in this case, the spark, or the could-be spark, was the Bank of Japan, the highly anticipated Bank of Japan interest rate decision, and more importantly, the statement that came with it. Now, for those of you who didn't catch the video, I'll catch you up a little bit. At one point, the Bank of Japan was widely expected to hike rates in April, but with global tensions and economic uncertainty, things like the US-Iran war that is still going on, or situation, maybe it's not a war, I don't know what terms they actually use, the tone has shifted. And like many other central banks out there, the move is going to be more of a wait and see approach. Now, the problem with that is this. The Japanese yen is extremely weak and Japan does not like that. So real quick on the funny mental side, right? That's what we call it over on the platform. Here's a lesson for you newer traders out there on fundamentals, right? Pretty much everything in the market comes back to interest rates, right? And interest rate decisions typically are driven by two things: jobs and inflation. A weak yen makes imports, right? Stuff they're bringing into Japan more expensive. This means higher costs for goods, materials, energy, food, basically anything that comes into the country. These costs, right, get passed down to people like me and you, and that contributes to inflation. So naturally, to deal with that, they want a stronger yen. But since they're not fully comfortable raising rates yet, they've been leaning on a tactic called, I think it's called like jawboning. I like to call it verbal intervention, where they're pretty much coming out and saying, hey, we would really not want the yen to go above this point, and if it does, we may have to do something about it. Is that a threat? No, it's not a threat. We're just saying, right? It's very similar to like around the house where your partner is like, hey, honey, do you want to wash the dishes? And it's not really a question. What she really means is, hey, honey, wash the dishes. I have learned that not through back testing, but from live market experience, and I now get ahead of things and wash the dishes well before she gets home. Therefore, I no longer have to answer that question. Anyway, like happily married couples who get the hint and don't make the same mistake twice, the market is also smarter than to fall for these tricks. And traders and investors, at least professional ones or experienced ones, they don't just react to words. We react to actions, and actions on policy, or I guess actual words dealing with policy, not underground threats. Anyway, what I'm trying to say is, we're not really fazed by this talk. We see it and hear it all the time. What we want is clear signals about future rate hikes, and this is why the actual statement, not the talky talk, was going to be important to us. So, as expected, Bank of Japan left rates unchanged. The quarterly outlook showed an upward revision in inflation and a downward revision in growth, largely tied to those global tensions. US-Iran situation, right? No real surprises here. But what did catch my attention, and I would suppose the attention of the markets, was that there were 3 dissenters who actually voted for a rate hike in April. And that initially sparked some yen strength in the market. And for those of you watching the visual version of this, you can see on the chart that as we came off this level that we were holding or waiting to break around that 216 level, we initially saw close to a 100 pip move straight to the downside off of that reaction to the perceived yen strength. With that being said, what you can also see is the market slowly working its way back up to that level. We went all the way down to about 215 even. We're back up to about 215 half. And there was a reason for that. Now, shortly after the rate change and the votes and all that information came out, Governor Ueda followed up with a much more measured and cautious tone, right? We'll call this a dovish tone. So the three dissenters was maybe more of a hawkish outlook, meaning hike, 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 hike. This more measured and cautious tone was more dovish, meaning, hey, let's just chill for a little bit. This is also classic central bank communication where people come out and they just don't want to say anything to get you feeling one way or the other. But he pretty much emphasized the need for more time to evaluate the global situation, but more importantly mentioned that he didn't know how many months it would take to determine the next rate hike. And in my opinion, this was the key line, because if we were going to see sustained yen strength, we needed something really hawkish. We needed something really aggressive, something clear like we're hiking June 16th. It's coming. You can bank it. And this was anything but that. This was kind of like, we'll see. So with all that being said, I don't think the market has any reason to change their tone from what their tone was before everything happened, which was weak yen. Now, this is a perfect example. And again, it's important to understand that I'm a technical trader first, so I am biased in that regards. But as we were discussing this very situation in our Monday Q&A session, a lot of the traders I was working with said, man, this is confusing. Glad I don't have to understand all this. And I think it's important as a trader to understand that we don't need to understand everything. One of the main reasons that traders never get started is because we are intimidated. We think we need a degree in economics. We think we need to go to a fancy university. We think that we need to understand all of the fundamental events and the drivers to participate in the market. And that's just not the case, right? Yours truly got D pluses in both his micro and macroeconomics class in college, and it's what really motivated me or scared me into changing majors. So if I can do it, you can do it. And from a trading perspective, we can analyze and overanalyze all this stuff and say this and say that. But from a technical perspective, if we just look on the chart, this will tell us everything that we need to know. Yes, this came out with more dissenters who wanted a rate hike. Yes, this came out with the governor saying, oh, we're going to wait and see. But at the end of the day, to simplify things as a technical trader, my job is easy. If we break and close above this line right here, then I'm looking bullish. If we don't, then I'm not looking bullish. It's pretty much simple, right? Do my analysis, wait for the thing to occur. If the thing occurs, wait for the next thing. And I'm not saying that you can't use this fundamental information in the background. It certainly does play a role. It's good for understanding maybe why the market made a move to break and close above that level, or maybe why the market went in the opposite direction. But as far as an actual trading perspective, the reason I love technicals is because it gives me a clear black or white rule set on what I should do, which takes a lot of my interpretation of how did that statement tone sound? What did he really mean by that? Were those three dissenters really dissenting? It takes all of that mystery out of the equation and allows me to focus on the things that matter most. And this is exactly what I mean every time I say, hey, be predictive in our analysis, but reactive in our execution, right? Anyway, I hope you guys enjoyed this episode. It's a little bit different from what we usually cover here on the Trading Coach podcast. But if you do like these current event style breakdowns, let me know in the comments section below. My busy season is wrapping up, so I'm looking forward to some downtime afterwards and looking forward to diving deeper into more topics like this and hopefully bringing you more video episodes as well. But again, this podcast is made by me, but really made by you for you. So if there are things you guys want to hear about, let me know and I shall deliver.